So what I'll do is I'll first go through, how do you buy crypto, right? How do you understand that? So how do you buy crypto and where would you get them from? So there are two main avenues, and I'll show a few examples. So CEXs, so centralized exchange. So they're the likes of Binance, Huobi, OKEX. These exchanges are centralized in the sense that there is a company behind them, they take profit, they operate like an entity, just like NASDAQ or ASX. The key there to understand is they take your funds, right? Unlike the traditional markets where you have a broker who take custody of your shares, these guys take custody of your capital that you use to trade and the tokens that you buy. What this means is that, so they're like a bank in a sense, right? So if they get hacked, then you may lose your coins, right? Now, unlike in the traditional world, there's no regulatory authority that that can sort of backstop the hacking, that can backstop, sort of give back your funds. If you get hacked, and often they do, it's really up to their discretion to say if they will reimburse you, if they will have insurance to cover you. So that's one big risk of trading on centralized exchange. And then the other one, the one that's taken off since 2019, maybe 2020, is DEXs, a decentralized exchange. Uniswap, Balancer, Sushi Swap, Pancake Swap, these are examples of decentralized exchange. What the key difference between them and the centralized ones is you have your own custody of the funds. So what that means is that your funds are always kept in the wallet, where you control access, you control the private key. So think of private key as a vague abstraction of a password in your account, right? So you have pure custody. The good thing is it's super safe. It's very hard to hack. To essentially hack a private wallet, it needs a quantum computing. The downside is because you have custody, if you lose it, no one else can retrieve your funds for you. Right? There are a few ways where people can sort of hack, professionally hack to get your funds back, but that will cost a lot and it's never guaranteed. So I've actually lost private keys before, and it's really it's quite a painful experience, right? so luckily it wasn't Bitcoin, it was some other smaller coins, but in the bull market that could potentially be worth a lot of money. So losing, and as far as I know, every single person who I know who actually has a wallet have lost their private keys before. It's always like a rite of passage. You have to lose it to make sure to really understand that you can't lose it. You can't, you have to really look after it. So the chances, to be honest, of what I recommend to start if you're just starting out is don't put much or anything into your own wallet, because the chance of you losing your private key and therefore losing your assets in it is much, much higher than a reputable exchange getting hacked. Right? So it's actually probably at an early stage, safer, quote unquote, for you to keep your coins or your tokens on a centralized exchange. So an example of a centralized exchange is here is, say, Binance. So this is a Binance. So Binance is probably the world's largest centralized exchange. It's I don't know, probably done out of Malta at the moment, but it's a very distributed team. It's not really regulated per se. It's even not regulated as a financial institution, so it's a bit grey there. But it's probably the safest, and it does have an insurance fund to cover any loss of tokens and coins. So how do you buy an example? So if you don't have, so in the way to think about it is we have AUD, USD, what we call fiat currency, right? And fiat currency, and then in parallel world with this crypto world, everything is detached from this fiat world. So if you don't have tokens, you want to get, the first time buying, you have to buy with a fiat currency, so AUD, USD. And the way to do that is you just do a wire transfer, or you can pay ID, do a pay ID from your bank account to to Binance, and then you essentially top up your Binance account with AUD, and then you can just buy whatever coin you want. Now, once you're in crypto, right, it's much easier to transact. So this whole fiat to crypto, crypto to fiat is like an on-ramp and off-ramp. That does have high transaction costs. It does mean that every action is easy for authorities to track. So normally what people do, a full-time in the space do, is once they on-ramp into crypto, unless they want to get out completely, they rarely go the other way. So I know people who have on-ramped like 5 years ago and they have never ever converted the coins to fiat, right? Now, that's not to say that you have to always keep in Bitcoin. This is volatile. So what happens if you want to take a profit? So an example of, let's say, as an example, is okay, so I hold Bitcoin, I bought it with AUD, now I want to get rid of my Bitcoin and take profit, but I don't want to go back to fiat. What you can do is you can sort of sell it and trade against BTC against USDT. So there's all these stable coins which are backed supposedly by some sort of sovereign currency. So in this case, it's backed against USD. So 1 USDT is equal to 1 USD. Therefore, you can actually sell your BTC for USDT and keep your profit, right? So take profit, you keep it all in stable coins, and then one day when you decide, okay, I get out of this space completely and buy a house, you then convert from a stable coin to AUD. So if you do USDT to AUD, it's really just an FX rate, just like you do in your work. So this is what I tend to do is once I'm in the space, I rarely go back to fiat. Just minimize that friction. The transaction cost is probably, I would say, 5-6 times higher going between a fiat and coins versus between coins and coins. Okay?
So can you explain that? Is it 5 to 6 times
higher? So typically, let's say, let's say AUD, buying Bitcoin with AUD, the transaction costs, but the exchange charges can be anywhere from 5 to 6 times higher. They're say buying Bitcoin with a stable coin that is denominated in AUD. Right? So that's one of the bigger frictions. And also, if you do go back in and out of crypto to fiat, your bank, right? Because this looks like a bank account. Your bank, you might have issues with that. Right? So one thing with crypto is once you're in there, just avoid, if you can not touch your bank, it's the easiest. Yeah. So this is an example of a centralized how you buy, and you literally buy just like, let's say if I want to. So in this case, the most liquid market is USDT. So if you want to buy with USDT, you literally just input down here. You want to buy, you can change the price, how much BTC you want, and BTC you can do a fraction. You can go all the way down to like 0.0001 Bitcoin. So you can buy like $10 Bitcoin. So you don't have to buy a whole. And that's one of the advantages people say versus say shares, right? You can't buy like half of a half share. You have to buy a whole share, and then just click buy, and this will the order will generally fill quite quickly. There's no brokerage. There's no brokering. There's no clearinghouse. So those used to trading equities, right? Literally trading this is you and the exchange. There's no one in between. There's no other parties to clear to settle, right? So here, buying and selling is settlement.
Is there a spread on the price?
There is a spread. So if you look at this spread, right? That's the sell. That's the ask, bid and ask. So the spread here is very small, like 1 or 2 cents typically. So less than 1 or 2 cents. There is a bid ask spread. Now Bitcoin is the most liquid. So this time the spread is very small. Other altcoins, which is less liquid, is you can have sort of a few dollars spread, right? Now, so this is trading against USDT. Now, once you have Bitcoin in a bull market, a lot of people say, well, I don't care about USD, right? USD is devalued, is inflationary. all I care about is getting more Bitcoins, which is hard currency, for example. So what you can do is you can forget about USD and you can say, well, once I've got Bitcoin, I trade against Bitcoin and I buy and sell Bitcoin against other coins to essentially build my Bitcoin stack. This is what people say, build your sats, right? Build your satoshis, which is the currency, the smallest unit in Bitcoin. So an example would be, if I was to go to, so see, these are the USD pairs. These are all these, altcoins that paired against USDT. So if I go to Bitcoin, I pair it against Bitcoin. Let's say, 1 inch. 1 inch is essentially a decentralized aggregator, exchange aggregator. So just think about it as and because this is a new account, okay. So here, see these tiny numbers on this side, right? This is literally how much is 1 inch against Bitcoin per 1 inch token. So you have to trade against it. So you use Bitcoin to buy and sell against 1 inch. Right, so that way you can stop thinking about USDT as a way to do profit. Now, generally what I do is in a bull market, all I think about is what is my BTC balance, right? Now, when I get to a bear market, for example, I might think, okay, well, Bitcoin is going down in value over time, then all I care about is building my USDT balance, for example, right? Now, some people, particularly funds, where they're managing other people's money, they don't care about building their BTC balance, they care about building USDT balance, which I think, in a way, is kind of an easy way out, right? Because in a bull market, you should be wanting to beat Bitcoin, because otherwise I can just buy and hold Bitcoin and just grow my USD, profit then versus trading. But anyway, that's just a personal preference. So yeah, so these are the basics of buying and selling on a centralized exchange, right? Now, another example is, say, notice this order book is fairly liquid, right? Even the spread here, is tiny amounts of Bitcoin. It's fairly liquid, it's centralized. The other thing about centralized exchange is a centralized order book, meaning that all the capital is pooled, with buyers, bids and asks are pooled behind the scenes into one pool, and the custody is with the exchange. So an example of the second type, say a DEX, it would be a Uniswap. So Uniswap is where it's a decentralized exchange. This is actually one of the first exchanges. And what you see here is that these are the tokens that's listed in Uniswap. To trade it, I need to connect to my wallet, right? So which means, I think at the moment am I connected? I think I might be. So this is this will be the wallet all set up. So I've got one ETH. This is my MetaMask wallet, which I have the private keys to. And so to trade on a centralized exchange, so here I have custody of that 1.08 ETH, right? And I can use that to trade on Uniswap. Uniswap doesn't take custody of my tokens at all. So let's say I want to say, okay, so for example, I want to trade Fade. So Fade is one of the latest projects, it's very popular. So Fade against ETH, right? So this just shows you the total liquidity in this particular pair. On Uniswap is 2.48 billion, the volume, the fees, and these amounts of the two tokens split in this particular pool. So if you go with the pair as a pool, right, you trade in that pool. And if you look at this, right, so what does this mean? Rather than saying buy or sell, you are swapping, you're literally swapping between two tokens. So you're swapping ETH for Fade. So this was the last trade, right? ETH for Fade, the total value traded was 13,000. And then, ETH for Fade, Fade for ETH. You're selling ETH, you're selling Fade, and you're buying ETH. Now notice the time right? 2 minutes, 4 minutes, 42 minutes. That's highly illiquid. Versus what you see on, say, on here, right? The time that you see here, the trade happens every few seconds, right? So that's one of the problems with DEX, is that it can be highly illiquid for smaller tokens like this. And the way to trade this would be, you go to trade, and because I'm already connected, see this is my account, this is my public key, so this is my account address, right? And I just say, well, okay, so I have 0 Fay, well, I want to buy some Fay, so I go to say, okay, so I can select ETH. Oops. Basically, I'm going to go say, let's say I did Fay. Oops. Okay. Change. So I can swap, X Fay for ETH. And our slippage tolerance, what this means is that because it's so illiquid, any large amounts, let's say if Fay to ETH is say 100 Fay to 1 ETH, right? Slippage means that I'm happy to take either side 99 or 101 Fay for the ETH. So that's 1% is not too bad. I've seen places where the slippage can be like 10%, which means you're actually never sure the price you get is the price input is your final price. Right, so playing with DEX is quite fiddly, and because this is on the Ethereum blockchain, so DEX means everything runs on chain, which means that the cost is quite high because the blockchain is congested, right? So I think there are times where a trade can cost up to say like $50 in transaction fees. And unlike a centralized exchange, your transaction cost is not a portion of the total volume of your transaction value. Your transaction cost is just a fixed number, reflecting on the traffic on the chain at the time. Which means actually makes DEXs not very sexy to trade if you're doing say only like a few $100 worth of trade, because your transaction cost will be like 10%, which means to make it back, you need to make at least a 10% profit or 20% profit, right, to cover the transaction cost both ways before you even think about making the overall net profit above fees.
What's the benefit?
The benefit, okay, the one benefit is that you, as the token holder, you take custody of the funds. So remember, these funds, these assets will always sit in my wallet. So no one else, because I have the private key to my wallet, so no one else can get it. Right? It's almost impossible to be hacked. The only way for you to lose these assets is if you lose your private key. But that is, trading on DEX that's the single biggest benefit. Yeah.
You can also access coins that haven't been listed on centralized
Correct.
exchanges.
Exactly. Now, one thing also, to list something on a centralized exchange, it can cost anywhere from, in a bull market, anywhere from say $200,000 to say a few $1 million. Right? Now, if you're a project, you think, well, I don't want to pay this much. This is open source. Well, at least the earlier version of the Uniswap is open source, which means you can, if you're a coder, get the smart contract, run your contract, and you're listed on Uniswap straight away. There's no approval because there's no central entity behind it. Right? Anyone can list anything. Like I can write a contract and list Gemma token on it, and if you wanted to buy it, then there's a market for it. But on a centralized exchange, projects can have to pay, go through a whole approval process, it's a bit longer. So now, given how popular Uniswap, the balance, and the different DEXs are, what projects do is they first list on a DEX, get some traction, get some liquidity going, and then they go and list on a centralized exchange, which has a lot more liquidity, but it's more expensive, having a longer process. Yeah, so that's the sort of the basics of buying or selling centralized versus decentralized exchange. So trading. So let's say you've bought Bitcoin, you've bought some tokens, you want to trade it. one strategy is, you know, if you don't have, you know, doing this as a hobby on the side, you have other things to do, then this is what we call hodl. You literally buy and hold for months, years, and then and so that, you know, some people can buy Bitcoin, like they bought it in 2009, 2010, you know, they'll be up probably tens of thousands of times, right? And that's what all they just buy and hold, which is a great strategy if you have conviction in the asset itself. Now, a lot of people, because of the volatility is very high, you know, it's not that uncommon for Bitcoin to go up or down by 20% in a day, right? So people will trade and make profit by taking advantage of that volatility. So what are some of the common strategies that which a lot of people use and I use as well? The first one is long and short discretionary. What this means is you can buy or sell a token or an asset just based on your own feeling at the time, what you think the market is going to do, all these different metrics is telling you. So that's sort of the long short. It's a very broad category, literally just buying or selling. Now the short can be selling an asset which you don't own, so short selling. Just like in equities, you can short sell, you know, Tesla, even if you don't own the asset. So it literally means you're borrowing the asset. Let's say I'm a short Bitcoin, I don't own any Bitcoin, so I borrow the Bitcoin from my counterparty. Often that comes at an interest rate or a funding cost I have to pay to hold that, to do that borrowing, and then I short Bitcoin. So I sell Bitcoin in the hope that it will go down against USDT, and then I can buy it back anytime I want, and that price difference is the profit I make, and I repay that Bitcoin to the counterparty. So that's what shorting, and long is just buying an asset, holding it and selling it for a profit. Event-based trading, so let's say for projects in particular, if you know that, you know, there's no such thing. I mean, you know, insider trading is illegal in traditional markets, but it's very popular and it is legal in crypto markets. So if you know, you have someone working Binance and they tell you, hey, we're going to list these 5 tokens, 5 projects next week, then the chance of these projects going up in price is very high. You can go and buy them in advance of the listing and then sell them just before or just after listing and make a profit. A little event based. It's triggered by certain events in the market where you think you have an information advantage versus the average person in the market. So exchange listings is one. Product milestones, releases is another one. Now, often these releases are like, if you search on Twitter, it's actually all public, right? So most information for event-based trading is out there. It's just simply you making a decision of whether you think the market will react, and 2 is whether you can actually find that information. The third one, volatility trading. So this is where, as the market matures, there are other instruments that you can. So both event-based, long short discretionary, you can trade with spot. So you just buy the underlying asset, or you can buy the futures, the contract, right, which is a derivative whose price is based on the underlying asset. So the Bitcoin futures contract expiring in June is a Bitcoin. It's basically what the market thinks Bitcoin will be worth in June 2021 when the contract expires. Now, with volatility, as the market matures, there are other instruments like options. So the option gives you the right but not the obligation to purchase an asset at a fixed price at the expiry date. So options is quite advanced trading. So like if you're just starting out, don't touch options, because options essentially gives you insurance. You lock in a price today for let's say Bitcoin in 3 months' time. So your upside is unlimited, but your downside is the price that you pay for this option conference insurance. Right? So it is asymmetric payoff. The pricing is based on this mathematical formula that has a fancy name called Black-Scholes. It's based on different metrics such as what does the market think about the volatility now versus the volatility in the future. It's very much based around what the market thinks of the volatility rather than the underlying value of the coin, right? So if you short options, so you're selling insurance. Yeah, short options, you're selling insurance, meaning that you can actually lose everything. You have unlimited loss potential, but your gain is capped at the cost of that option, right? So from time to time, yeah, shorting options is very, very dangerous because for those, you know, if you're not familiar with it, you can actually lose your entire portfolio in one go if you short options and the market moves against you, right? So from time to time, I do short options, but you're very careful. You can hedge that short with other methods. So anyway, so that's just an example of volatility trading. And then the third one, which is more probably last 12, 18 months, is what is called what I call DeFi products. So this is where you can farm, right? You put your an example. That's an example. I'll put an example. Going back to Uniswap pool, right? So if I go to Uniswap, so this may or not make, so let's say this pair, right? What you can do is you can say, okay, I'm going to put my ETH, add liquidity, so I'm going to put my ETH into this pool, right? This pool currently has, let's say it has this many ETH and this many FATE. I'll put 1 ETH in there, and then and Uniswap, and I get these tokens called liquidity pool token, LP tokens, right? Which means I'm giving the market liquidity, and in return I get a share of the trading of the fees that Uniswap gets. Now, so this is what you call sort of farming. This is very basic explanation of farming. It gets very complicated. It's based on a mathematical formula. It's based on a curve. There are risks to it. So it's not people say, oh, you're always going to make a return and have this great, APYs. APY is sort of your annualized yield. But you can understand it's highly volatile. You have losses. There are losses, and there are. And the thing is, there are losses which you don't even see because you don't realize until you look at the maths and look at how the curve moves. So if you're starting out, I suggest that you don't do farming. And this is called farming because literally you place your ETH in the pool and you do nothing, and you watch your balance grow, which is great, until it doesn't grow or until something happens. Yeah.
How do you find the LP token in your MetaMask wallet? Is it automatically added, or do you have to find a smart contract somewhere?
Yeah, so the LP tokens is automatically from memory. So I haven't farmed Uniswap for a long time, but if memory is added, you have to go and claim your LP token in that particular pool.
Yeah.
Yeah. So this is so that's an overview of the different strategies you can do. And then so how do I trade this? Okay, so what do I do when I trade? So first of all I look at the project, right? I look at the actual token itself. I say to myself, I don't want to get in and out of this token, but if I'm stuck with it, right, because the trade was incorrect or I made a wrong view on the market in the short term, I'm stuck with it for, what they call the trade turned into an investment or years, right? And would I be happy with this? So this is where you always start with the fundamentals. So let's say Bitcoin, right? I'm happy to hold Bitcoin for say a few years. Therefore, the fundamentals are sound, and then I look at how do I make short-term profits based on the trading. So fundamentals are looking at the particular token. How does it have value, right? How does that token accrue value in a project? Bitcoin example is commonly referred to as a store of wealth. It's a hedge against inflation. So people buy it as if they're buying gold and just hold it. Right? So that's the value of Bitcoin. Ethereum is like, think about it as money, right? With Ethereum, to do any transactions on the Ethereum chain, you have to pay gas, which is denominated in ETH, right? So that's like money. There are other tokens, so look, there's like 2,000, probably 4,000 projects, each with a token. Now, many of these projects, the tokens have no value because they don't need a token. So you can be a blockchain project with no token. That actually makes a lot of sense. But in this market, every crypto project has a token. So an example, you just look at, okay, so what do I get? What do you get as a token holder? Shares in a company have value because you have dividend rights, you have voting rights, you have all sorts of rights. But as a token holder, often you don't have many rights at all. So what do you get as a token holder? So let's say exchange token, Binance. The centralized exchange Binance, it has its own token, BNB, right? Now BNB, last time I checked today, was like worth $400 a token, which is about 20 times its price 18 months ago. So why has it gone up in value? Well, because as a BNB holder, you actually get benefit from growing profit and revenue in Binance. So Binance is part of its profit, so we'll buy back the BNB tokens and burn them, which means the supply of your token reduces over time. So in theory, the price per token that you hold should go up, right? As long as Binance keep on buying back. Yeah.
Is that at risk of being considered an unregistered security, like XRP?
Yeah. So one of the, which I'll get onto that. So one of the risks of having a centralized project with a token is that if the SEC, if any authority decides, look to say, hey, sure, this token has, people can use it on your platform and get discounts on the fees, that has utility. But at the same time, people are buying it with the expectation of making a profit because you are, spending all part of your profit to buy back the tokens to reduce supply, and therefore the price will increase. Therefore, this should be considered as an investment. So BNB should be registered as a security, right? And you're not. And that could be, if that is the case, then in fact Binance will be probably fine, but this is illegal, right? Because you're selling a product that should be security, but you haven't registered as security. So that's the risk of centralized tokens like that. Now Binance, that's why in some cases I say Binance, they say that, I think now they may be able to, but for a long time said you can't, US investors, traders cannot participate in the Binance exchange, so therefore they are outside the purview of the SEC. Right, so the SEC has no jurisdiction, so even if the SEC thinks Binance has done something wrong, but because they have no jurisdiction over it, they can't do anything about it. Right, so these are the regulatory risks that has implications. But if you're a DEX, there's a Uniswap, then SEC might have issue with Unitoken, which is the platform token of Uniswap, but who are they going to chase after? Sure, they can go after the founder. Now, I'm not sure how Uniswap is structured as an entity. You may not have an entity, right? So it's decentralized. So that's also what makes a purely decentralized project much safer from a regulatory perspective. Yeah.
I was going to say they filed patents for Uniswap v3, so it's not going to be open source anymore. So I guess there is a core team that's protecting their IP.
Yeah. So then who filed that patent and so if there's an entity that filed that patent, then I guess in a way SEC can go after that entity and say your Unitoken has all these issues, right? But that gets super complicated. But the point is that the fundamentals of the project has to be sound. The token has to have value somehow, right? And then you look at other things like the projects, the team, the traction, to have users. In indexes, often they talk about total value value locked, so TVL. So it's like, as a fund, what's your AUM, right? Asset under management. Obviously, the more it's locked up in these pools, in these sort of pools, in theory, the more valuable Unitoken should be because it has traction, it's generating fees, the fundamentals stack up. So let's say, I've looked at BNB, for example, and I like the token, the project is sound, and I want to buy it. So then it becomes a trading house. Okay, so what do I buy with? I can buy with spot. I can buy with futures. So I suggest all options, right? So I suggest starting out just buying with spot. So like I want to buy some BNB, but then what do I? How do I like? Should I buy it now? Should I buy it at a high price, lower price? So that's where things like the off-chain analysis, which is technical analysis, comes in. So what is off-chain analysis? It's kind of witchcraft and wizardry in a way. I don't use it that much, to be honest, because it's just I don't quite get it, but a lot of people do. And in the markets, if everyone thinks this particular line is resistance to support, and therefore you become the self-fulfilling prophecies. An example would be, let's say, these are these fancy lines. These are just moving averages over different time periods, right? So if I was a technical analyst, I would say, okay, so let's say the red line here is a 25 time period moving average. I can say, well, when the price hits this point, it's going to bounce back up because it's providing good support, right? And if everyone in the market thinks the same, then this becomes the support. And you can see, as the price has touched this over hourly, it's gone back up, right? So these are some of the literally witchcraft and wizardry people look at, and actually people spend. Particularly short-term traders sometimes spend hours each day looking at these fancy lines. I look at it just so that I know what the market is thinking, right? I don't necessarily trade on those lines. One, because it's a very short-term thing, so and when I buy or sell, I tend to hold for a while, right? So these lines don't really matter. So these are what I call off-chain analysis, right? Technical analysis. Now, what I'm more a fan of is on-chain analysis. So what is on-chain? On-chain analysis looks at the underlying demand and supply of the token. So, So an example is, let's say, what's a good, okay, there's a project called DHT, right? So DHT is an asset management protocol. So on-chain analysis, and because it's ERC, it's an Ethereum token, if I do my homework and a bit of a detective, I can actually look at which wallet is holding, which wallet are buying and selling DH, the token, if I can track, if I know who are the people behind these wallets, then, and I see, let's say if they're a big fund, and I can see them keep on buying this one token, right? And I'm sure that wallet belongs to this fund, and I can say, well, actually, if they're buying, then the chances are, based on my previous analysis, the token's price is going to go up. They're going to move the market. I'm going to buy some too. So this is what I call on-chain analysis, what everyone calls on-chain, because the thing here is, because everything on the chain is public, so you can always see the flow of funds between wallets, between exchanges. The trick is to know which wallet belongs to who, and therefore what are the chances of that particular wallet being able to move the market, particularly for small projects. Not so much for Bitcoin. I mean, Bitcoin, sure, in March when there was a massive dump, it was because there was a particular wallet that moved about 6,800 Bitcoin into an exchange in one go. Right, so these are more fundamental supply and demand. Right, this is really supply and demand, and that's sort of what I look at a lot when I trade, because it's very hard to manipulate the supply and demand. Right, if someone's buying, they're buying. So one tool I like to use to look at this on-chain stuff is a project with a company called Nansen. So Nansen literally tracks these wallets, and you can actually see the on-chain analysis. So that's an example of let's say, so DHT is DH, and what this shows you, it shows all of how much of DH is on the exchange, right? So 2.8% on the exchange. It means that 97.2% of it is in someone's wallet, which means that the likelihood of DH dumping is very low. It's simply not much to dump. It's only 2.8% of the total supply. things like, it also shows you the different it also shows you the different these are the different exchanges, right? The different DEXs and centralized exchanges, and the split of the DHEDGE across these different exchanges. Right, so these are the things that tell you, okay, so where is DHEDGE traded most? It's traded most on Uniswap. If I was to trade it, I want to go to Uniswap too, because that has the most liquidity. Right, so there's different information that you get from looking at Nansen. Other things like depositors versus withdrawers. If you withdraw a token from exchange, chances are that you don't want to sell it, right? If you deposit, you see a lot of people depositing, it means they're probably going to sell it. That's why you deposit from a wallet to an exchange, is to sell, right? You don't deposit from a wallet to an exchange to keep there for a long time. These are the notable wallet transactions over time, so you can see which wallet has been, red is been leaving the wallet, right? Which wallet has been leaving, which wallet's been accumulating. So these are labels that Nansen has given to particular large exchanges. So heavy DEX trader is actually a fund, right? So they're not going to say which fund it is, but it's actually a fund. You see this fund, in the last 7 days has been selling, or has been withdrawing or sending the token from this particular wallet somewhere else. Now, it doesn't mean they're going to sell it. They could be sending it to another wallet, could be sending it to another exchange. So you can actually track the flow of the funds, and you can sort of arrange it by the change. This is sort of going out of the wallets or going in. So who's been accumulating, right? So Huobi has been, so that's an exchange wallet. So lots of people has been putting DHEDGE onto the Huobi exchange. And then you can also track what are the top transactions by value, between which wallets. So that's something which I spent a fair bit of time on Nansen just to look at what the tokens are doing. So that's looking at the actual token, right? Another way I look at it is so let's say this particular wallet. This wallet belongs to it's got $3 million worth of tokens in it. So this wallet actually belongs to a fund. Right? I'm not going to say who, but they can move the market. They may be able to. In some cases, they can actually move the market. So if I would say, okay, so what have these people been buying and selling in the last few days? I can actually put them into Nansen and look at it. So the way to do this, right? So this here, you look at from a particular wallet perspective, and you can see wallet profile. And this is where a lot of the funds gets annoyed if people are tracking them and they realize people are tracking them, because it's like someone looking at your bank account and monitoring your bank account every day to see what are you buying and selling, right? But that's the beauty of blockchain. As soon as you know, or you think you know what it is, that's interesting. It should actually come up unless after the spaces. Right, so this is a heavy DEX trader, but that's the label. So it's got heavy DEX trader, token millionaire. He has very few ETH, but he has lots of other coins, right? So look, okay, so you can probably deduce where they are based on time of the day that they're active. You can look at, okay, so these are the top tokens that they hold. So let's say SFI is something which I've been tracking for a while, and one of the reasons I've been looking at it is fundamentals are good, and now I look at, okay, so this particular fund owns a lot of SFI, so as long as they're not selling, then the chances of SFI dumping is very low. Right, so these are the things, that sort of detective work you can do with a product like Nansen. And you can see that this particular wallet, where they are interacting, which exchanges they're interacting with, both buying ETH and selling ETH. Right? Things like and this shows sort of which wallets it's interacting with the most. So yeah, so this is sort of the as a trader, it becomes very interesting, right? You can't do this in a traditional world because everything is behind the scenes. It's not public, right? And I think this is what makes trading in crypto much more interesting than trading because in a traditional world, unless you have insider information, which is actually illegal to trade on, you're stuck with looking at these sort of technical lines, right? Yeah, which again, I'm not a big believer in that, but a lot of people are, so therefore they do turn up correct sometimes. So this is, I think that is the end of me talking. Yeah, so far any questions before I go into the actual setup of wallets? Yeah.
How to calculate tax?
Sorry?
Tax.
Yeah, okay, so tax. So different countries have different ways of looking at tax. Australian ATO, if you trade frequently, right, it's actually considered actually capital gains. Yeah, if you do short-term trading, it's considered as capital gains, which means that if you don't hold it for more than 12 months, you have this tax that's not discounted, right? But if you register as a business, as a trading business, then the profits you get from that is like company profit, and you apply the usual 30% tax on the net profits. So you are, in theory, you are meant to keep record of every single trade you do, what you buy, what you sell, how much you bought at, how much you sold at, and then report to the ATO at the end of the financial year, your tax return. Now Binance is to do any on-ramping or off-ramp, as soon as you come into contact with a bank, traditional banks, you have to go through KYC on any exchange. So Binance, you can deposit AUD, but you have to go through full KYC, which means, in theory, if ATO wants to go to Binance Australia and goes, all the record of everyone who's ever traded on your platform, all the Australians, they have it all. They'll have to hand it over, right? Yeah, so that's what tax is in short. Now the question then is, okay, so that's the basic trading, but crypto has become so complicated that you can do things where you have Bitcoin sits on its own blockchain, right? But you can wrap Bitcoin into other, so that Bitcoin can then also be transacted on an Ethereum blockchain, which are two paradigm chains, right? You can do a wrap Bitcoin, which in theory is 1-for-1. So what does that mean? Does the action of you wrapping a Bitcoin and then trading it on the Ethereum blockchain, does that, makes a taxable event, right? Does that makes it, lending out your Bitcoin and then earning an interest? What is that? Does that, are you making a profit in capital gains terms? I think that sort of thing is quite unclear. So basically, because wrapping is fairly new thing, and you don't worry about wrapping when you're just starting out, right? Because wrapping it's very fiddly. This is examples of, sure, the basic trading and selling taxes, it's fairly clear, but as soon as it gets more complicated, it's unclear what's the tax treatment of what we're doing. Okay, so wallet. So before, what I showed you before is what I call software wallets, the MetaMask, my Ether wallet. So these examples where it's connected to your desktop, connected to your plugin, your Chrome, and you can then do trade with it, right? Another type of wallet, which I think is even safer, is like a Ledger or a Trezor, which is a USB-shaped stick that you plug into a computer and you use it and trade, and then you unplug, and it's completely, because it's a USB stick, it's not connected to the internet, it's super safe. And people want to be safe, You know, people often store like large amounts of Bitcoin or tokens that's worth a lot of money onto these hardware wallets, and then you put it into in a safe, lock it up, you know, for safety. Yeah.
I was wondering how that works, because like Bitcoin Ledger, of course, is public, so that's always online, so that'll keep a record of which wallet has what, whether or not it's connected to the internet. Is it that your public key is offline, or
Your private key,
key is
yeah,
offline?
yeah, you only put the private key in when you have your wallet plugged and you enter the phrase, you know, the key to access your tokens and trade, right? And then once, so as long as your private key is with you and no one else knows about them, then the hardware wallets are fairly safe. Probably like the safest of all. You know, even other things like an old mobile phone that you don't use, that you completely switch off all connections, put into permanent airplane mode. You can actually use that as your wallet as well, because you can download a wallet and then disconnect it to the rest of the world forever, and that mobile becomes your hardware wallet. It's a very cheap version of it, but it works quite well. So for example, like my 2FA, so one of the things when we log into an exchange, email, password, and also a Google authentication, right, or a Microsoft authenticator. So for that, that just adds another layer of security. What I do with my thing, Google 2FA, is I keep it on a separate mobile, my own mobile, which the only use I have it for is to authenticate. It's completely disconnected to the rest of the world. It's on airplane mode the entire time. You know, I don't have to carry it around with me if I'm not using it. So that's another way of keeping your stuff safe. So these are the sort of the wallets. Now, the last thing that I'll do is, if there are no more questions, I'll go through a thing about how to actually set up a MetaMask wallet. And for those of you coming next week or the week after for the NFT session, you will need to have this set up, because I think James will actually go through how to issue an NFT, and the first step is you need a wallet. So I'll do the MetaMask wallet. So I actually found quite a good, so MetaMask is literally this thing. So it's this thing, this wallet. It's a Chrome plugin. So what I would do is I've literally looked at. So if you guys have your desktop, laptop open, you can literally just follow the steps of installing a MetaMask. The first step is to get the Chrome extension from your from the Chrome store. And I'll actually do it with you. I'll find sorry. So MetaMask.io. Right, you download. So I've got Chrome. You can download, depending on what your system is. Download the Chrome.
Can I ask us the Wi-Fi?
Oh, sorry. Yeah. So once everyone's got connected to the Wi-Fi. Does everyone who needs Wi-Fi have Wi-Fi now? Yep. So does everyone else? If you have Wi-Fi, just go to MetaMask.io and then download download one of the Chrome, go Chrome, otherwise iOS and Android. So if you click on that, oh, and then go download. We're following? Yeah. It's downloading. Install MetaMask for Chrome, or you should have like for iOS and Android. Add to Chrome. Yes, you want to say yes. You can change your trusted add extension. Okay, so it's been added. So you should see this little fox picture on the that should have popped up on your plugin, and if you click into it, you should come up with "Welcome to MetaMask." Get started. So a seed phrase is so you have a private key and a seed phrase. A seed phrase is really a backup bunch of words that you need to keep so you can access your wallet. If you, let's say, if you change computers, you re-download MetaMask, you just enter the same seed phrase, recover your wallet, right? So in this case, I assume that we don't have the wallet, so let's set it up. So you're going to create a wallet. Okay, so if you scroll down to, so you would have gone Android? So Chrome, yep. Up to you, yep, so if you have, okay, yep. Or Chrome, yep, and then if you scroll down, you should have install, you should have like install MetaMask for Android. Yeah.
And then it will go on my phone, so if I want to go on my laptop.
Do you have a Chrome? Do you have a Chrome? Yeah. So then go to just Chrome.
Yeah, I'm
Oh yeah. And then initially install MetaMask for Chrome. So you click into it.
Yep.
And then you should come up with this store, right?
So what is MetaMask?
Sorry? What does it?
Just add extension?
Yeah, add extension, yeah. Yeah, so see how it's popped up now. It's just popped up on the side. Get started. And then you should have, so after you got get started. Sorry? You click, no, the other one, the new, get a new wallet, create a new wallet. Yeah. If you click on create a wallet, you should come up with this like help us improve. Up to you, you can say I agree, no, you don't have to. You can say you agree, reference if you want to, yeah. Now, so this is where you enter a password. This password is what you use to log into your MetaMask on the same browser that you have installed the plugin, right? So this is the normal password. And if you forget the password, it's not end of the world because you can always use your private key to log in as well, right? But it's just easier, right? So let's say I'm going to make a password.
Just alphanumeric.
Yeah, alphanumeric. So so I'm just going to do a very basic password. Right, you've agreed. Yeah, you've got that? Yeah, and then great. Now, so here is where you would have to if you click on yours, the only person who should know your seed phrase is you. You should, so if you click on this, there should be a bunch of like 10 words that come up. You click on it. I'm not going to click on it because I'm actually used to go down the track. So if you click on it, you copy this somewhere, you know, write it down, copy it into a Word doc, copy it somewhere, because that. Sorry? So yeah, so if you click into it, right, then you should get this. You don't have to do it now, you can do it later, but do it before you send anything to that wallet, right? And that becomes your recovery phrase, recovery words. It becomes these phrases become the words, and order is important. Write it down in the exact form it is presented here, right? So that's the number one thing. That's one thing that you need to remember and not forget. Okay, so token swapping, what this means is MetaMask has connected itself in the back end to all these DEXs, right? So if you want to switch between tokens in MetaMask, you can, in the back end, we'll pull the best quote from each of these DEXs. Yeah, so that's just telling you that you can do that. Okay, so you can start swapping, and that should give you. Okay, so don't worry about this for now. So don't worry about the swapping. Swapping, you literally can just convert between tokens, but you don't have any ETH yet, so cancel. Okay, so this is your account, right? So your account, and you now have your first MetaMask set up. Now, what does this mean? So a few things here. Your account, this number, this bunch of alphanumeric string is your public address. So this is what you send to people if you want them to send you tokens. So think of this as your account number, right? This is public. You can share it around, you know, and what you come up with. So no one knows it's you unless you tell them, because it comes up in public, just a bunch of numbers and letters. Yeah.
You said you can click on the reveal secret words. What was the next step that you got?
Yeah, so you can remind me later, and then yeah, what does that come up? It should be.
Start swapping.
Yeah. So you start swapping. So you don't have any tokens. Right? You just get out of that.
Just cancel.
Yeah, cancel, and then you should come up with this page, and that's your account page.
Yep,
Now, a few things to note. Your Chrome. Okay, so you should come up. So see how I don't have the Chrome on my top right hand side, right? So if you click on this puzzle thing on Chrome, you should be able to get MetaMask. If you click on it,
Does it say like bookmark, is it?
yeah, you can say yeah. So we're therefore every time. Oh, hang on. Maybe pin it. Click on the pin. You should pin it. So now, every time you open this browser, you can just, so even if you get out of this, right, you can just see the MetaMask here. And you can, send, buy, sell tokens. At the moment, by default, it only has one type of token, Ethereum, but you can add token, because there are thousands of tokens you can add to this, right? And the way to look at this is, I'm sure James will go through this next week, but etherscan.io is like the window to the Ethereum blockchain. And it shows you can see all the transactions between wallets, including yourself. So how you search for it is,
The EtherScan.
yeah. quite sure. Maybe the internet's been slow. I don't know why it's taking. Sorry, Ether scan. Maybe it's Ether scan. Ether scan. Is Ether scan coming up at all? Because I've got full connection. I'm not sure, maybe it's down. No, actually, this scan should be down.
Yeah, you should Google it.
You Google it?
Yeah.
Does it work? You Google it? Okay, so if I Google. Okay, so Google Ether scan and hopefully you can go. Yeah, etherscan.io, okay? So this actually shows you. So let's say if you go to your, if I go to the wallet, right, my wallet, and I see this account. So if I copy, you can copy, just click on the wallet account to copy, and you place it in here. Well, you're actually searching your this is your wallet. So everything's public, right? At the moment, there's nothing in there because you set it up. So this is actually public, what you have, this is like your bank account for Ethereum.
So just checking your Ether scan eventually loaded up with this.
Yeah, so I just click Google off Etherscan and then just click into it. Yeah, but normally like etherscan.io should come up very quickly.
It does go up now.
Yeah, so I don't know why, yeah. So, now, let's say I bought some USDT with ETH, right? Now, it's not coming up on my wallet because I haven't added that particular ticker. So what I do is I can just go to Etherscan. Each token has a contact address. So the USDT, you search USDT on the top right. On the top right of Etherscan. Yeah, and that is called, and that's the tether, right? That's the actual token, is tether USD. So it's one for one. And we have, you have this is the contract address. I don't know why.
Oh, so you click on Tether, is it?
Yeah. And this is the contract address of Tether. Normally it's quite quick, I'm not sure. Maybe if the scan's overloaded.
Still loading.
Yeah, so if you copy this contract address and you add it to your MetaMask in add token, and that will come up as you have the Tether token added. That will show up in your wallet as well. But there you go. So, and this literally gives you. So there are, at the moment, 22 billion tokens, right? Outstanding for Tether. You copy this.
So you copy the contract.
Yeah, yes, yep. So, and then so here you just copy address. Yep. And then you can see you add token. Oh, sorry. USDT, yeah. Is it frozen? Yep. Yep, copy. And I go and then go to your wallet, the MetaMask, and then go add token at the. So if I can, so I go back and I go. So this is your wallet page, right? And you go add token on the bottom.
Oh, you have to click it.
Yeah, add token, and then you can say search token. You add the contract. Right, and this comes up as when you search. So add Tether.
How do you copy it again?
If you go back to here,
Yeah.
if you place a cursor next to the address, copy can come up.
Close next.
Yeah, copy.
Okay, these two simple copies. So click on
Yeah, just click on it. You've copied
copy.
the address, and then you would
Control V to the search tokens.
and then you do it to go to your wallet, the little fox.
In the box, yep.
Yeah.
Add tokens thing.
Add
yep.
tokens.
Yep.
Everyone following? Add tokens.
shows up the symbol tether.
Yeah, so you just Control V and that tether, you click on that.
USD, yeah.
So and next. So would you like to add these tokens? Yes, you add tokens. So now you should see, if you, and then you go back to your, you go back to your wallet, you should now see. So this is reminding you, right, to get your seed phrase, right? So you go back up now, but you go.
So when you were, it was OUSDT, the central swap.
So yeah, so you can see. Basically, it's forcing you to back up your seed phrase before you do anything, right? But at the bottom, you can see there's a USDT token added. So if you send money in, now this will come up as $100 worth of USDT.
So that's where you click the back arrow, right?
Yeah, because that's the wallet homepage.
Yep. Yeah, so yeah, it comes over and on.
Yeah.
So this question, so this, if I have like, let's say, clearing
Yeah.
outside the exchange, can I
Yeah. So the way to do it is you withdraw from the exchange, and the address you put in is just this address. You copy this address and you paste it into the withdrawal section of the exchange. It's just like you're transferring between banks, right? You enter the destination account number to here. What's happening?
So then who holds this? Is this an exchange as well? Is MetaMask?
No, this is you. This is your wallet.
Okay.
The only person who can access this is you. If you lose it, it's gone. So there's no, like, you can't, you know, there's no one to talk to on this. So that's, be very careful.
Basically, this is the soft.
This is software.
Which I think some says it's not as secure as the hard.
Correct, because it's connected to the internet, but it's more secure than exchange because you own the private key. Right. Yeah. So that's so now you just have a wallet. So next week or in 2 weeks, when you guys have the NFT session, you can then you know, deposit some ETH and then start issuing your own NFT using this wallet.
Now, I have to deposit the fee. Do you need to have USD?
Yeah, so I'm not sure what James. I think he's trying to work out the best way to get some ETH to you. So maybe that.
Because I was thinking if you need USD in advance, like when you convert, you need USD.
Oh, you can buy. You can just buy ETH with AUD as well. Yeah, that's it. Well, I think at the time James was saying he might, if he has some, you know, some ETH, he could just like give it to you and you pay him like AUD in cash. This is only a very, very small amount. There's a test issue, so you shouldn't do that. But the key thing is, yeah. So now like MetaMask is making you to back up before they then even do anything else, which is what you should do. Cool. I think that's any questions?
I have a question for you. With these contracts, from my understanding, they're on-chain as well.
Yeah.
And they can be transferred. Can you transfer contracts? Because this has come up before, and I was not aware that you could transfer a contract.
When you say like trace.
Transfer. So who has ownership of these contracts?
Well, no one. Well, once you deploy the contract, it's open source. There's
Right.
no. I don't know when you say own the contracts. It's only like who owns the IP of the contract, who owns the code.
I'm not. So I've heard that these contracts, because I sort of work in this space. I'm not in the crypto side of things, but previously a contract has been transferred to someone else, and then they sort of gain ownership of these tokens, or they can mess with the contract and do things that are not intended.
Are you talking about things like what happened with Sushi Swap and like they transfer like this anon person transfer the ownership of the contract?
It's the contract that creates these ERC tokens.
Okay, so
Or is that a different?
in
the
theory,
tokens we're talking about?
it's the same, you know, contract to contract, right? So you can contracts can create tokens, contract and transfer tokens, different core functions. But I think what you're saying is it's like let's say a project team has a contract, writes a contract, and that contract can mint X number of tokens. Now, that contract, in theory, is once you deploy a contract on chain, it's very hard to change the code. Right? So you guys have deployed a contract and mint 1 billion tokens. That contract is public for everyone to see, but you can't really change the code itself. So who owns the contract? Yeah, maybe, yeah, sure, because the team owns the contract in the sense that they wrote the contract, but once it's deployed, you can't do anything unless it has a particular function that allows you to continuously to deploy tokens or something that's written in the contract before it's deployed. Yeah. So yeah, in a way, in a sense, if there is a bug in the contract that allows people to do things, to add functions or to mint endless amount of tokens that is unintended for, and someone else gets hold of that knowledge with tech skills, they can actually just continue to mint tokens. And that's what, in fact, that's how sort of hack happens in DeFi, in this decentralized finance space. Is people find bugs in these contracts and just end up minting endless amounts of tokens.
Yeah, I think that's the scenario that happens.
Yeah, but that's like, I guess in a way it's a bug. Yeah, it's a bug that's maybe unintended, maybe intended, but once so yeah, anyone who finds a bug can exploit that bug. Yeah. Any questions? I haven't used it, to be honest. At the moment, my trading is mostly done out of sort of the main, for the centralized, it's sort of Binance, the old school ones. It's been around for a while. But I know there are lots of, but I actually think that decentralized exchange DEXs will eventually overtake the centralized exchange because its functionality is being improved every day, the liquidity is improving. It's just evolving so quickly, and that's why Binance now has a DEX. A lot of centralized exchange has a DEX as well, because they've realized that if they don't have DEXs, one day they'll be obsolete. Other questions? No?
Thank you so much for coming, everybody, and thank you to Gemma for being with me.
If you guys have any questions, feel free to.
Yeah. So tomorrow we'll be sending out all her social details and also the slides for today and any resources as well. Yeah. And as she mentioned, the rain's. As she mentioned, next week we have our NFT workshop. We do have a change of speaker, it's Victor now from our wallet. But yeah, so you've got your wallet, so now let's make some NFTs. We have the same kind of deal going on where we'd love for you to bring a friend, especially since we're making NFTs, so you can make an NFT with your friend, why not? Yeah, so hope to see you there next week. Yeah.
So can you grab an NFT with an empty wallet, or do you need to be?
You probably need some money.
You just gotta pay. So what's an NFT? NFT is just an asset, right? It's literally it's a smart contract. So an NFT in its purest form is just a smart contract that represents some sort of a dog or like in a vehicle on the chain. So to deploy, if every time you deploy a contract, you have to, which is issue a contract, you have to pay gas.
Is that going to be like
Maybe. Yeah, depends. If you do it midnight, maybe it's cheaper. But it's, yeah, I think, yeah, if it's this time of day, it's probably going to be, in my week, now the thing with often also to note, the reason it's so expensive at the moment is often in this different crazy, DeFi plays, because it's doing one contract, unknowingly you are doing like contract on contract. Because often these things build on each other. So which means you have to pay for the fees of all the contracts underneath you, and you assume all the contract risk underneath you as well.